Hello everyone, welcome to How to Invest for Beginners. Make sure you are using your money wisely and taking control of your funds and your future. The power of your income. Your income is your most powerful tool to become wealthy. You need to avoid debt at all costs because if you do get into debt, you will become a slave to your lenders. The less of your income you give away in payments, the more you can invest and grow your wealth. Investing to build wealth. Investing is key to long-term wealth. An example is if you're investing $500 per month in a good growth stock mutual fund from age 30 to 70, this could grow to be approximately $5 million. The financial industry focuses heavily on investing, and for a very good reason. Diversification is key. You shouldn't put all your money into one type of fund. There are 4 types of main funds that you should spread your money across. You need to spread your investments across 4 types of mutual funds for better stability and performance. These main ones would be growth, growth and income, aggressive growth, and international growth. Growth funds. These are typically mid-sized growing companies, and they include index funds like S&P 500. These offer a balanced growth and risk. Some actively managed mutual funds in this category can outperform index funds. Growth and income funds. Invest in large and stable companies. Tend to grow and decline very slowly. They are consistent long-term performance. Aggressive growth funds. Focus on small companies and startups. High risk, high reward, very volatile. And what volatile means is very unpredictable. These often include tech and innovation companies. These can outperform the market very quickly but can also crash just as fast. International funds. Invest in companies outside the United States of America. They typically underperform compared to American companies, but still important things is global diversification. Diversification is key because you don't want to keep all your money in one country's economy. Because if you do and the economy crashes, then all your money is going absolutely nowhere and you're gonna lose it all. Choosing the right funds. Look for mutual funds with 10-year or longer track records. Check the performance by comparing it to an index fund. If the mutual fund consistently outperforms the index, it's a very good sign. Avoid funds that consistently trail behind the market. Index funds versus mutual funds. Index funds. They track the market like the S&P 500. Low fees and consistent performance, but they are still subject to downturns. Mutual funds. They actively manage potential to and have potential to outperform the market. They have higher fees but come with advisor support, which is very important if you don't know what you're doing with your money or you're new to investing. And you need to choose mutual funds that beat the index, and by doing this you could use a prospectus to compare. The role of a financial advisor. Advisors help guide your investment strategy, provide expertise, and reduce the emotional risks of DIY investing. Good advisors are worth the cost if they help you stay consistent and avoid mistakes. The importance of saving consistently. The savings rate is a #1 factor in retirement success. 74% of success comes from consistent contributions, or the 74% of retirement success. It's not just about choosing the right fund, it's about putting money in regularly. The final investment principles. Be patient. Wealth builds over time. Don't invest in things that you don't understand. Stick to what you know and control your money. And make sure you avoid bragging, stay focused and disciplined. thank you so much for watching, everybody. I hope this helped you a little bit, and have a great rest of your day.